A couple of months ago, I made a friend. Let's name him John. John was a novice trader who was struggling to make consistent profits in the market. He was constantly searching for the next big indicator, for the next big strategy, but nothing seemed to work for him. That was until he discovered the concept of premium pricing, equilibrium versus premium pricing, trading the Fibonacci level using premium in the markets. He learned how to trade using premium, using equilibrium versus premium and how it works instead of working against it. Within 2 weeks, John's trading account began to grow. He was finally able to achieve consistent profits in about 3 weeks' time. So if you want to be like John, make sure you implement everything that I'm going to be talking about in this video here. Do not skip any part of this video because it will be the reason as to why you're not profitable. So welcome to the world of forex trading. Welcome to Top Forex G, where understanding the concepts of equilibrium versus premium can make a difference in your trading success. Imagine being able to predict market movements and make profits in the forex market with ease. That's exactly what equilibrium versus premium can do for you. In this video, we will dive deep into these powerful concepts, and I'll share with you step-by-step processes of how I find these trades using equilibrium versus premium. So sit back, relax, get ready to unlock the secrets of equilibrium versus premium in forex trading. So let's get down right into the video. So hey traders, so I'm going to be using the Euro USD today, and first is first, the higher time frame principle, the daily time frame principle that all of you guys should follow is do not do anything on the daily time frame until price hits equilibrium first. That's fair market value. When price hits equilibrium on the daily time frame, that's when you drop to your lower time frames to study price for entries. Its context is not entry signals. Banks sell at equilibrium or higher, and higher, that is premium. If meat at a grocery store costs $15, then price rises to $18. That's when you want to start selling it so that you have profits of $3. That is a premium market price. That's a premium market price. Anything above equilibrium is premium. So the first step is identify my directional bias. This is pretty simple. Directional bias of this is to the downside. Why? Because market is making lower lows and lower highs. So let's pull out our Fibonacci. Our Fibonacci retracement tool is going to be helping us today. So the first example is in a downtrend, we draw the Fibonacci tool from a swing high to a swing low. Swing high from the week to the week of the swing low. Swing high to the swing low. And I'm going to be explaining to you guys the importance of each and every key level that I have put here. So we have equilibrium, we have 61.8, we have 70.5, we have OTE. OTE is 78.6, so we have 100 and 0. We have TP1 and TP2, and we have TP3 also. And I'll be adding a little bit later on. So let's go. So in this market here, swing low to swing high to swing low. Then, remember the higher time frame principle, we wait for price to go into equilibrium. But before that, we have to identify that the swing low is made. And how do we identify that? We need 4 candles. The first one, right? The second one that makes the low, the third that turns, and the fourth that ensures that we are going to equilibrium. So you don't do anything here. That's how you get stopped out. Here, price didn't reach equilibrium, neither here, but here. As you can see, when price came into equilibrium to 61.8, that's our golden area. So price reached here, closed immediately, and look how price rallied. Price rallied right into our 0.0 level. That's why you always want to take your first take profit, or right just below it, because price is taking out all the lows. That's a liquidity area. Remember, whenever there's an expansion happens towards where old liquidity is. This is an old low which had to be taken out. It's as simple as it gets. Simple as that. Price expands to liquidity, and when expanded to that, it continues to expand to TP1. Now TP1 is negative 0.21. You can add that to your Fibonacci or write it down. TP2, I will tell you that in a second, right? That's my secret, right? So we hit TP1, TP2, and TP3, as you can see. Simple as that. Let me show you guys another example, but this one is kind of different from the first one. So we draw it from the swing high to the swing low. Then price retraces right into our golden area. That's from equilibrium, the 50% level, fair market value, 261.8. Price comes right into it, and then it starts consolidating right there. It starts consolidating at equilibrium, fair value. As soon as price comes to equilibrium, of course, we have to drop to the lower time frames and hunt for our selling opportunities. This is context. It's not sell signals, right? Remember, at equilibrium, that's fair value. It's neutral. It's a neutral to bearish condition, right? So price consolidates here. We know after every consolidation there's an expansion. An expansion, to solidify that we are going to be selling here, expansion happens to liquidity, and that's to the old lows. So we have very many confluences here. There's no way you could lose these trades here. So when that happens, look at this. Price closed. It's the body of price closed at the peep of equilibrium, as you can see. Close right there. You go to your lower time frames, you enter. I'm going to be showing you guys how you should do that step by step. So make sure you're still watching this video till the end, because if you don't, it's going to be the reason as to why you're stuck. It's going to be the reason as to why you don't buy your Bugattis. It's going to be the reason as to why you're not consistent. You know what I mean? So make sure you still watching this video all the way to the end. Let's go into it. So we hit tip here, but look, price makes equal lows, which have to be taken out as liquidity. There's sell side liquidity below that, taken out. We hit TP1 and we get shy of TP2. Let me take you to an interesting third example. So after that, we take that swing high to this swing low. Sorry. Swing high to swing low. Right there. Right there. Price still here, for this example, price comes into the 61.8 to the 61.8. So whenever price comes to 61.8 till OTE, that's our sweet spot. You just want to be hammering sales, just hammer sales all the way to 0.0. Take out liquidity, TP1, TP2, all the way. You just hammer sales. There's no way you could go wrong. That's why patience is key in this business here. You have to be able to be patient when it's doing all this, because when it's doing all this, everyone is getting stopped out. Novice traders, like the example I gave you above, that's what that trader was doing. The guy was just hunting for everything, using RSI, whatever he was using, and it wasn't helping him at all. 61.8, that's the sweet spot. You take the cells. Then we get an example. Remember, each and every example is different from the previous ones. We get this one. So this price retraces, it comes back, it goes shy of equilibrium. I told you guys, price has to come back till equilibrium. If it doesn't come till equilibrium, you do not enter. It forms equal highs, starts consolidating. We do not trade in ranges. I've told you guys in multiple videos, you do not trade in a range. Price comes back. Now, when price is making equal highs and equal lows, you just know there's going to be a manipulation to the upside. Since this is a sell directional bias market, there's going to be a manipulation to the upside. A manipulation happens to the pip of 61.8. When that happens, you drop down to your 4 hour time frame, 1 hour time frame, 30 minutes time frame, and you hunt for sell opportunities. Even if you miss that, you wait for the next day. This candle here closed below equilibrium, but coming from 61.8. When it closed, you hammer sells right from there. You hammer sells till 0.0, whereby we're taking out all liquidity. Then TP1 also. Here, you hammer sells all the way. You just hammer sells all the way. Why am I saying that? Because you're on the right side of the market. You're sure that the market is going down. You feel me? Next one. Remember, I told you guys, each and every example is different from the other. And I'm giving you guys a look at each and everything. So we have this. Price rallies. Makes a low. 1, 2, 3, 4 candles. It comes back. Price comes back right into equilibrium. Here. So you go down to your lower time frame. You didn't find a trade. You wait. Price rallies through 61.8 almost to 70.5. Then immediately rallies back. Price cannot stay in premium markets for a very long time. I've explained that in the previous videos many times that you can count. It can't stay up in premium markets for a very long time, and you can see it just dropped. After that, you just continue hammering sell, take out equal lows. Of course, you know it's going to take out equal lows, right? That's where the liquidity pools are. All lows, price always expands to liquidity. Takes that out, comes back, takes out TP1 also, takes out TP2. So we are hammering sales all the way from here. This is like 1,000 pips when the Euro USD this pair moves, right? Another one. I swear, guys, at the end of the day, you must be profitable. At the end of the week, if you implement the steps I've been taking, guys, you should be profitable. You should be laughing your way to the bank. You should be laughing your way to the bank, because this is extremely simple. At the end of the day, if you not see growth, it's because you ignored. It's simply because you ignore what I've been sharing, guys. I promise you growth if you watch till the end. Look at this. Swing low, swing high to swing low. Price comes back. Equilibrium. To oblivious through it. For sometimes you have to be patient, man. You have to study price. You have to know how price that works. Oblivious through 61.8. Then it comes to 70 to the pit. I told you guys, price does not stay at premium prices for a very long time. Then what happens? It rallies to the downside. So from here, 0.9976 till down here, 0.96. That's 400 pips, right? You didn't reach to 0 because price is simply reversing. It's changing the trend. We've been in a downtrend for a very long time. It's changing the trend. But of course, we have all lows here. We took those out. Right? We took those out. So you don't have to be greedy all the time. Sometimes just look at all lows like this one, take them out. 400 pips in the market. 400 pips. You either put your stop loss to break even, or you take your profits out. You feel me? So let me use the USD JPY too. The USD JPY has some nice examples too here. Make sure you're watching this video till the end, because I promise you growth. You're gonna grow consistently. You're going to make a lot of money. But if you fail to understand these simple concepts, it's gonna be the reason as to why you're gonna quit. In fact, I've grown very many accounts, very many live accounts I've seen in all the previous videos I've been sharing with you guys. I've seen what works. I've seen what doesn't work. I've done that, which is why I'm sharing you guys. Remember, I have nothing to sell to you guys. I have nothing to sell to you guys. I make this video so that you can gain value from them, learn, make money, and join the 1% club, the money making team. Let me just make this simple. Boom, equilibrium, sell. Right there. Even here. Bang. Price come back, equilibrium, sell. Take out the old low. Still comes back. Above equilibrium. Doesn't even take too much time there. Just bang, sells to 0.0. TP1. Look at this. This is the pair I'm watching next. I've been patient. Swing high. Swing high to the swing low. Right there. To the pip. Bang. Equilibrium. Here. Wait for this candle here to close. Then we shall drop down to our 4-hour time frame and look for our sell signals. It has not yet reached equilibrium, so we ain't taking any sales, man. We need at least to breach equilibrium. That's when we shall think of this trade there. And besides that, it's even still in the what? In a minor uptrend. You see this? So you must be having all concepts in your bag, in your arsenal, so that you're not surprised. You feel me? Do you feel me?